Major funding for these programs is provided by HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Greenberg Traurig LP, the Moynihan Group. Additional funding is provided by Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Fremont Investment and Loan, James D. Kuhn Real Estate Institute at Syracuse University, Massey Knackle Realty Services, Meridian Capital Group, McSam Hotel Group, Must Development LLC, Newmark Knight Frank, Palin Enterprises, Rosenthal and Rosenthal Inc., Swig Equities, the Engel Berman Group, Titan Capital, the Wickoff Group, YL Real Estate Developers, Extreme Contracting and Deconstruction.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. Everybody loves real estate. Everybody watches the Stoller Report to find out what's happening with real estate. But who lends money on real estate? And you know, now there's this perception that there's a credit crunch in real estate, and certain lenders aren't lending in real estate. So what did I do? I brought together 4 gurus, the people who really know what's going on in lending, the keys of lending. Today, my guests are Jamie Merman, Senior Vice President of Helaba Bank, Pat Goldstein, Senior Executive Vice President and Chief Credit Officer of Immigrant Bank, Dave Martin, Managing Director of Wells Fargo, and last but not least, a returnee, my good friend Jim Fitzgerald, Senior Vice President and Head of Lending for North America of HSH Nordbank. So, you know, Treasury bills the T-bill rates have gone up. There's this perception, there's this credit rating, there's this Moody's, these rating agencies. What's happening? I mean, I'm happy that the 4 of you came, but you know, I invited some of these people from, big brokerage houses or other banks, and they said, "No, we can't come," because they didn't want to talk about what's happening over there. What's happening today in the credit market? Is it getting tougher? Are you becoming more stringent in your lending?
I think most of the impact thus far, Michael, is really on the fixed rate 10-year side. It's the IO that's gone away, the interest only, and the particular focus on cash out deals where there's no equity left in the deal, and spreads have obviously widened. Really, it's the discipline that probably all of us as balance sheet lenders practice every day. Some of that discipline is coming back. But
why did this happen? Okay, I mean, everyone sitting here has seen cycles. Okay, this is not my young program that I had the week before, you know, where I had the average age was 29. And even these people, some of them had seen cycles. Real estate goes up and down. Pat's been selling, buying real estate, you know, unfortunately for banks who've had problems over the years. Okay, are we going to have this problem again? Do you perceive that we're going to have this problem with lenders, with some banks being in trouble? Or some securities firms being in trouble with portfolio of loans that they may have booked?
I hope so.
Boy, why are you so mean to them?
We're the last people standing right here. No, I think you know, I've been keeping my powder dry for so long. I need more storage, waiting for this market correction, and I think everyone, including the rating agencies, became undisciplined in how they've approached some of their underwritings, and I think some of that now is coming back to haunt that industry. And I think the balance sheet lenders who have stayed disciplined throughout this period, and I think we're all included in that, I don't want to say we'll get the last laugh, but I think we will be the last people standing, and hopefully we'll do better than the competitors.
Pat?
Yeah, I would agree with Jim on that. Going to the rating agencies for the moment. The rating agencies, you know, I had discussions with them over the last number of years, and you can see their credit criteria where, you know, originally they were stronger when they were doing the fixed rate CMBS a number of years ago. But this pressure to put the investment banks to go into CMBS and CDOs and new types of products, non-cash flowing products, which before they had been very stringent on. You know, they were getting paid by these people, and they were afraid they were going to lose their positions.
Right, but you know, this is an interesting thing. I remember going to a seminar maybe about a year and a half ago, and I heard Bill Green, who was the head of Wachovia, head of all real estate lending for Wachovia, and someone said to him, "What do you think interest rates are going to be in 9 months?" And Bill Green publicly got up there and he said, "All I care about is where are interest rates in 45 days?" Because I'm a bookmaker, basically. He didn't say that, but I called him a bookmaker because he took the loan and he sold it off, and he never kept anything like you keep on your balance sheet or like you do. And I think that's been part of the problem. And I think what happened, especially, you know, in New York City, you know, we've seen some of the Maclau properties, which were underwritten in 7 days, you know, being acquired. And, you know, if you're a prudent lender, you have to remember that you can't take this hype that rents are going to go that high. We were talking prior to the show, you know, how high can rents, you know, if a building's selling for $1,000 a foot, you need how much?
$100 a foot rents and up.
Right. And my question is, not every, and I think we discussed this with you the other day when we were talking with the bank. You need some more space. And your landlord, who's a friend, let's say hypothetically, if you need another 30,000 square feet, you're probably paying $55 or something like that.
Correct.
He wants $125 a foot.
Mm-hmm.
Hey, you're not a hedge fund. You need to make the money. I mean, not everybody can afford this. You know, unfortunately, I've had people the last couple of shows saying, "Oh, you know, New York City is for very wealthy people. There are accounting firms, there are professional firms, there are small businesses. They can't afford it. You know, not everyone's going to be able to pay $100 a square foot rent."
Well, that's a $64 million question. And if you look at what happened in California, and I know your show's about New York, but you saw the evolution of rents on the West Coast in San Francisco, Silicon Valley that went through the roof, $80 a foot, net, net, net. And when it hit the peak 7 months later, it had dropped all the way back down to its historical lows. And so the question is, will these high rents be sustainable in this marketplace? That's an interesting equity bet. I don't think it's a prudent debt bet based on the risk-adjusted returns we get. But
you know, prior to the show, we were talking that Dave and Jamie are both in a brand new office building to be built, and it's a spec office building. It's a great developer. I mean, SJP and Prudential are very strong people, and if you take the statistics of what happened with Ratner's building next door, you know, it was a spec office building, it did well. But it's a risk.
Well, I think having vacancy today that you can lease, or at least vacancy you can talk about that's going to be built, that's pretty powerful. I think the folks that are buying buildings without a lot of rollover, and you have to project way out into the future when you're going to capture those increases, and you're buying it at a 3.5 cap, that's tough on a lender to take down that story.
Let's leave the office, okay? You know, prior to the show, and we're talking, you know, we're tri-state region, but, you know, we were talking about the condominium market. I'd like your opinion, each one of you, your opinion of the condo market in New York City, then going to Jersey City and Hoboken, and then we'll get, okay, Manhattan, condo market.
I like it, but I like it with the right people in the right locations. I think some people will have trouble that have gotten into some transactions where there's no differentiation on location. I think location is important. I happen to like the very high end of the market, 15 Central Park
Which you were
West.
in, right.
We co-underwrote that with Euro Hypo. Totally sold out, record numbers. We're about to close on a follow-on transaction with Global and Zeckendorf's at 10 UN Plaza, which will be a high-end product. I like that end of the market.
Right, because that market, you know, there's X number of units, there's a certain buyer who's going to buy those units.
Interest rate movements are not important to that buyer.
Right.
We've stuck to Manhattan, and no grand strategy. We would go to the outer boroughs, we would go to Jersey City. We just probably don't have the coverage that we need. But we've done within Manhattan probably all price points, you know, from $450 a foot starter homes that are up in Harlem to it's really rent stabilized product that's being converted in a non-eviction plan to much higher end stuff, $1,800 a foot. Nothing as high end as Central Park West, 15 Central Park West. But I think this, we lend all over the country. We probably have 68 offices, which is a staggering number, all over the country. This is by far the healthiest for sale market. It really stands out.
I agree with him. It's the healthiest market, but I also agree with Jim that I think you have still, at this point in the cycle, we have to pick our shots where we're going to be, in Manhattan or if we go into Queens or Brooklyn. Who the developers are, that they have the strength, that they know the market, what they're doing, and also that I think some locations, and I think there's been a problem in some projects over the last 2 years. It's quiet, but there are projects that are being restructured. Mezz lenders have lost money, equity lenders have lost money.
I think
the banks.
those are the certain projects which are conversions. A lot of these
Right.
conversions,
Right.
where people thought that the prices would go, they would have no problem with the tenants. They had, there are
Right.
a number of those which are.
Right, you have the conversions, that type of conversion, but you've also had problems with the renovation conversions where there's been a lot of cost overruns too.
Right, that's what.
So if you don't have the developer that has the skill base, back to developers that have experience, there have been several institutions that have had problems with those deals. Now, luckily, there's been some bailouts by the market because it's been rising.
Sure.
But at some point, it just can't continue to rise. So I agree with Jim. I think on the high end, there are people who can afford the top locations, but there are people that can't afford the continuing rise in prices, and there's going to be some selectivity as to where they go in the future.
Jamie, you've done a lot in Lower Manhattan, and but you don't. You really were talking prior to the show. You don't like Jersey City and Hoboken.
Yeah, I mean, I think it kind of to sort of repeat what everyone else has been saying in connection with who's doing the project over there and the sponsorship and who's involved. It is a market, though, that we're not that comfortable with in terms of having a lot of knowledge about the depth of it and what's been going on over there. And we do go to Germany for all our credit approvals. So right now, Manhattan is a known commodity.
I mean, you can't show them a picture of Jersey City,
It's tough to show them a picture of Jersey
What
City
about
and
you?
explain that deal.
I mean, Claudio and
Branston, Missouri. We did a deal in Branston,
Okay,
Missouri.
so-
There were
so
three
they're gonna
Germans who've
Right,
been to
compete against
Branston,
us.
Missouri.
Okay, so you compete on Branson, Missouri. But, you just did a very interesting deal, and and I think we'll age ourselves. The West Side, at one time there was always a dividing line. Even in the East Side, it was once 72nd Street, it was 86th Street, and then it was
Right.
96th Street. And 96th Street is still there, but it's gone into Harlem. But you did this very interesting deal at 808.
Columbus, yeah.
But that's a double interesting deal because New York City is under retail, and that's a great interesting deal. Why don't you tell me a little bit about
Yeah,
that?
it was, it's Gluck, Rosania, and Chatreat. They owned the property for quite a while. I came up with a clever structure to create fair market rental housing on a base of 700 linear feet of retail. Whole Foods is already signed up, and the market is looking for that tenant in that market, and they're excited about it. Great views of Central Park. There's a view corridor there that's great, and that whole area just keeps getting better and better and better. In fact, we're hoping to get mandated on a project right across the street with the same borrower, so we're excited about that. But it is a great project, and in the context of everything that's going on in our business, you classify that a no-brainer.
What about Harlem? I mean, I'm very bullish. I've always liked Harlem. You said you did some conversions, in Harlem. What about new construction in Harlem?
We haven't seen any requests come to us for new construction. I know there's some projects up there on 145th that are new construction, 110th Street. Actually, I take that back, 110th. We wanted to get in that deal.
Right,
and,
one.
we competed for it, for the land loan, and came in second. That's a fantastic deal.
You see, but that's Central Park.
Yeah,
It's not really Harlem.
it's cheating. Yeah.
It's an oxymoron of what the location is. Pat, have you done things, and are you interested in doing Harlem?
Yeah, we haven't done anything up there. We are, we're looking at it if there are deals coming in. The retail deal at the Home Depot deal is up there. So retail is a
Right.
big thing up in Harlem. So it's not just residential.
No.
And-
I mean, the East River Plaza,
Right.
which is on the FDR, 485,000
Right.
square feet. You know, you have two great sponsors,
That was a great-
Blumenfeld and Forest
Great
City.
deal.
Mm-hmm.
We looked at that. And so you have a mix. Some office buildings are going to be started now, some are bars. So, you know, we're looking at things as they are happening, but we haven't really found the right deal yet.
You know, the week before I had this show where my average age of my guest was 28 or 29. Yuppies is not the term now. It's called echo boomers. And echo boomers want to go to Williamsburg. And I think, Pat, you said you even took the train to Williamsburg. I always take the train. I walk around. Well, have you seen deals in Williamsburg? I mean, with the exception of Williamsburg, Greenpoint. Fitz's brother was a cop in Greenpoint, so you know that area well. But what's your perception, of the Williamsburg market? You know, they're planning so many units over there. You know, can it absorb it? You know, there's only one little choo-choo train. You know, and that's the problem. I see that in Williamsburg.
Yeah, I don't want to say the best days are behind that area, but I think it may be too late to get in at the right price point. And we didn't invest the time early on to go study it. We were fully deployed in New York. So I think there's probably a lot of exciting things. I know there are a lot of exciting things that have happened there, but we didn't play a role, and I just don't know if it's too late or not.
Pat?
Yeah, I was concerned that there was going to be overbuilding. What's happened to a certain extent was, you know, the three projects were on the water, and the only one that went forward was Toll. And the project next to it, which is like a conversion of a
184 Kenton, right?
Yeah, they haven't gotten started. And Levine is just going to start as Toll is, you know, hopefully they'll be sold out. So it has staged itself more than one would have expected. There's a lot happening around the train area, the subway. I thought it was going, actually, they were beginning to slide the prices a little bit during the winter months, and supposedly it's come back. But I just don't know if they can handle a large inventory there, because even though the kids like it, it's very price sensitive. I mean, to start saying the kids like it, but you have to charge $850, $900 a foot.
Yeah.
And these are the youngest ones. These are the kids that are 23, 24, not the 29 and 30-year-olds. So, you know, they like Williamsburg, but at what price points? That's what I'm concerned
As a
about.
lender, what do you think of Long Island City? I mean, Long Island City, you know, in two aspects. I mean, the residential rental, residential condos, and the office market.
Well, we've been actually very bullish on the residential portion, and specifically Queens West. We're involved in the land financing with Rock Rose on the on their site. We're also involved in the two buildings that they've done, and we're expecting to be on in probably every one of the 7 buildings that they're doing over there. So, I mean, that's kept us very busy, just that site by itself. Haven't really looked at much else. You know, as you get further east off the water, you know, Avalon's there and there's some of the office, but you know, mainly Queens West development is where we've
Yeah,
been.
it's 2 segments. There's that, which
Yeah.
has been very solid and terrific.
Ditto for us. We're in the same deals with Jamie, and what's interesting is that that stuff on the water there gets rents in the low to mid 40s, and you go over to Jersey City, which is much more evolved, but the rents are in the mid 30s.
Yeah.
So even without the amenity base.
But you know, now it's very interesting. You talk about the rents. Do you have an idea what Avalon Bay's rents are on First Street and the Bowery in
Yeah.
Avalon?
Approaching $80
$80 a foot.
with the Whole Foods there.
No, the Whole Foods is
Yeah.
70. The newer one is $80 a foot. That means that a studio is about 2,800, and a 1-bedroom, because the 1 bedrooms are small, are about 3,600, and their 2-bedroom is $8,600. $8,600 for a 2-bedroom? You know, you have the nice new, you have the new Bourne's Hotel, but you also have the Salvation Hotel, Salvation Army. I mean, have you?
You can walk to Katz's from there.
I know. And you know what else you can do when you walk at the Cats? You can go to Edison's, because they're just building a place called the Ludlow right next door,
Yeah.
right adjacent in the parking lot next to Katz's, so you can have that.
Perfect.
But I think those $80 rents, that's an extremely desirable place to live. We have a guy in our office that we imported from Los Angeles. We didn't even let him come out to interview. We just said, you got to come out here. In a day, he found his apartment there. The word had gotten back to LA, that's where you should live. He wanted to experience the real New York as he viewed it. He's paying $80 a foot.
I mean, it's a lot of money. You know, so and who can afford? You know, this is part of the problems. You know, $80 a foot is a lot of money. So you know, it's I don't want to the perceived bargain. It's a bargain to be in Long Island City for 40.
Yeah.
It's a perceived definite bargain to be in Jersey City for 32. Okay, but you know, it's just a question of relative. You know, hospitality is hot. It's hot. I think Richard Bourne spoke at a REBNY meeting about a week ago. He said in the 70s there were 120,000 rooms. Today there are about 75,000 rooms. Have you guys and gals been lending in the hospitality market today?
We have not been. We are thinking about
You
it.
can't show a hotel to the boys in Frankfurt?
We, you know, it's a business that you know, you lose your tenants every day. So it's one that a lot of the lenders look at as a business.
It
you
is.
know,
It's an
versus
operating
real
business,
estate.
no question.
We have done. We've been involved in some hospitality that's been part of mixed-use development projects where there's condominium component and big retail component and a hotel component. A standalone hotel by itself, we have not been doing. Some things come across our office recently that we're kind of looking at, but it's still, I think, you know, right now it's like Richard said. I was at that conference also, and that you know, no matter where you go, no matter what you put up, no matter if the air conditioning's working or not working, and what the room looks like, you're going to sell out every night. Question is, where are you going to be in 2 years from now? You know, where are you going to be in 3 years? You know,
And
kind
it's
of
also an
short term.
operating business, Pat.
And it's an operating business.
We've done a lot of hospitality, not in Manhattan yet for, you know, a variety of reasons. I don't know exactly what, but we've done quite a bit. Both a couple of resorts, L.A., Del Mar, smaller stuff, some stuff in Texas. And this is new construction. We've done a lot of opportunistic buys with reflagging or improvements. We like the sector. We think it's a very hot sector. We got into it a couple of years ago, so we think we have good people, and it's a good market. I do agree that they could overbuild here, but you know, they're building pretty small buildings at the moment, so you know, you just can't replace the large sites yet.
David?
We tend to have a reputation, probably deserved, of being pretty picky about sponsorship, and I think that's probably true for all the lenders here. I think with hospitality that's even more so because it is an operating business.
Right.
And we've done a fair amount of boutique hotel construction with just a couple names in the city, Richard being one of them. And so I think if you stick to the guys that really make it their business, they're not just dabbling in hotels, and you pick good sites, you'll be okay. We're actually looking at a project that would be a branded product, be a courtyard over in Jersey City. And it's, Long Island City. And it may be a little bit before its time, but I think the land basis and the proximity to Midtown, it's gonna work.
I will say to you, I like Jersey, Long Island City, but the king of multiple hotels, who's been on my show, who's building 29 hotels, said, "I built the first hotel in Jersey, in Long Island City, but I'm not building the last." There's a lot of sites on Long Island City, and if what Pat just said, if the market slows down, the first site that's going to hurt, you know, people are going to Long Island City to save money. Those are the people who are going to come back, and that's the potential risk. Jim, I know you really don't do hospitality in your.
Well, we have a small group that's devoted to that space and is active around the country, doing a lot of development deals. And I think they've done some sexy things in New York.
I think they did the Standard Hotel. They were doing the Andre Village Standard right now. They did they've done a couple of deals in Manhattan. You know, we're talking Manhattan. You know, it's very hot. You know, I got to the subject of Newark, and I really want to talk about Newark. Dave, you told me that you finance Newark, but I want to talk about Newark. Not on the station, okay? Because that's a separate entity. That's like somebody saying, I went up to Harlem on 111 Central Park. That's not Harlem. What's the perception, and do you think you can get your credit committee or the people that you're involved with interested in Newark? James?
Again, we haven't been there, and I guess the answer is in a lot of the markets you've talked about. You know, we chase clients, not transactions. So if Howard Milstein wants to build something in Newark, we'll go to Newark or Hoboken or Harlem. Our clients haven't taken us into these markets. But if a deal made sense there, we'd do it.
David?
Well, I think that's our philosophy exactly. We follow the client. It also helps to know something about the market, and other than the office tower near the train station, we certainly don't know the market over there. We'd need to invest some time. But
Right, because the interesting thing, Dave, on that is the people who work in the office tower, they live in the office tower. I mean, I don't physically live there. It's like when Citibank built the building in Long Island City. They went there, they worked there, they had their lunch there, and they left there. And that's what happens in the Newark Tower that we're talking about. You know, Military Avenue in Newark, no one's really run into the situation. Have you done anything?
No.
That's a simple, sounds like no, and it doesn't look like it's going to happen quickly.
But you have a new political administration.
I think it's a
into
great
the city.
political
Yeah.
situation. Everybody is Greenwich. All of a sudden, Greenwich became this hot spot of the world. What's your
I
perspective?
don't know. It's similar to what Jim was saying about Newark. It's if Related, Rock Rose, SL Green, the clients that we do a lot of business with, if they show us a deal there, we're going to look really hard at that deal.
But you wouldn't do it for some new developer?
No.
No?
No, I think that would be a
No.
tough sell.
Greenwich? Pat?
Well, it's a high price point, if you look at some of the office stuff and what it's trading at, to really want
1,100 a foot, I just heard
Yeah.
some
Yeah,
building
that's
trades
That's what I
for
call it,
1,100.
it's like a $200 building that's selling for $1,100. It's not even a good suburban office building, and it's selling for 11.
Since
so.
I know Brother Fitzgerald and I grew up in Brooklyn, there's this story, and I don't know who else, I don't know if you grew up in Brooklyn, but, Coney Island. There's a lot of discussion about Coney Island, entertainment, companies like Taconic and City Investment have made an investment, spent a lot of money buying property from Joe Sid, thinking about the market. Do you think Coney Island is ready for residential?
I think a residential deal could work there at the right price point. At $1,200 a foot for a condo, I think that would be a tough sell.
I think it's $600 a
but,
foot, maybe.
yeah.
You Fitzy,
Yeah.
any idea?
I think they should bring the steeplechase back in the saltwater pool.
Really?
Yeah.
Then you'll get
remember?
1,200.
Pat?
Yeah.
Coney Island? I mean, you people are big lender in New York. You like New York?
I'd say what Dave said, if the right developer went there, and, it's also a question of leverage. I mean, I think things will sell there. Right. So it's, what are they selling? What price is it at? And what amount of money do we have to lend?
Right. To sum it up, I think that the general concept is that all of you still are interested in lending, but you really look at the as we would say of the old days in banking, you look at the C, the character of the borrower,
Right.
and I think that's the important thing. You don't look at if you're going to sell it for loan like a bookmaker, like these other banks, and not the banks, the securities firms, and everything. And that all four of you are continuing to be bullish on New York on selective basis. And I'd like to thank all of you for being here: Jamie Merman, Pat Goldstein, Dave Martin, and Jim Fitzgerald. Next week, we're really going to get into a topic which I didn't bring up today, the subject of 421A and its effect on the residential condominium market. See you next week.
Major funding for these programs is provided by HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Greenberg Traurig LP, the Moynihan Group. Additional funding is provided by Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Fremont Investment and Loan, James D. Kuhn Real Estate Institute at Syracuse University, Massey Knackle Realty Services, Meridian Capital Group, McSam Hotel Group, Must Development LLC, Newmark Knight Frank, Palin Enterprises, Rosenthal and Rosenthal Inc., Swig Equities, the Engel Berman Group, Titan Capital, the Wickoff Group, YL Real Estate Developers, Extreme Contracting and Deconstruction.